welcome to Cigars and Syndication. I'm Robbie. I'm here with my co-host Jay, where we're passionate about cigars and real estate. And today we're going to talk about the current apartment shortage and maybe what led up to it.
Hey everyone, my name is Junaid Noor. Welcome to Cigars and Syndications. We're going to talk a little bit about a, a mixed bag of different things: apartment shortage, housing shortage, interest rates. It's all interconnected. So we're just going to have a discussion while we smoke this fantastic Avo fall season. This is the third um, in the series. They started with the spring, summer, and this is the fall.
Well, yeah. So I know we just a few episodes ago we did the summer. We've now got the fall one. This fall one is really good. It's starting off really good. It's got a good even burn to it so far, and is really a good bold flavor. I like it. It's a solid smoke.
So we'll review the cigar a little bit later in the podcast, but let's get started with the housing crisis. What is going on? And mortgage rates are at 8%. Um, supply is short. Developers are not developing as fast. What in the world is going on there?
Yeah, I mean, it seems like this is kind of a repeat from 2008, and we still have some lagging effect from 2008 that we haven't overcome yet with particularly apartment shortages.
Yeah, I read a statistic that said that we are still 600,000 units short nationally, just to catch up to the 2008 shortage.
Right, and this interest rate and housing crisis and all these things that are at our doorstep right now are they're hurting getting caught up, and it's like what's it going to take to get over this hump and get these projects going.
And another interesting statistics I read was that the U.S. needs to build 4.3 million units, apartment units, by 2035, just to keep up with demand. So that's a lot of apartment units. And well, let's get into what happened here. Why are we so short on everything?
Well, I mean, it seems like back in 2008 when we had this that crisis, the lenders shut down. They weren't lending money on multifamily. Apartments weren't getting built, and it just kept compounding on each other until, recently we've had a pretty good run at getting these newer projects approved, getting the lending for these projects, and then here we go with the interest rates rising and just kind of shutting it down again.
Correct. And that's just it, right? We were at a really, really good um, mastermind seminar in New York City this past weekend, which was sponsored by Lone Star Capital. Shout out to Rob Beardsley, who put a fantastic. His team did a great job putting it together. But there was, I like to attend these kinds of sessions because I learn a lot of what's going on in the market, where the market is moving, what other um, capital raisers are dealing with. And one of the things, we had two separate, very good separate sessions about debt and equity. And, let's get into what we learned over there.
For me, it was really interesting, and it always interesting to talk to other syndicators and developers, and how they overcome some of the challenges they're faced with, and the different ways that they get money, different ways they extend their terms and negotiate with their lenders, whether it's on the debt or equity side.
Yeah, and one of the things that I learned out of that is that, lenders are slowing down lending for the building of apartments and, of course, housing, standard single family housing too. And, population growth is still happening and looks like we're going to wind up in the same uh, supply gap that we had right after 2008, which we still haven't caught up with yet.
Yeah, I mean the consensus of a lot of people that were at this conference was that we're going to have the same issues. Construction slowing down, new starts are slowing down. Some areas like Texas are getting an influx of new residents, and it's going to be a pretty a pretty big shortage. And once we do get the gate open back up and people are lending and when we're building these things, I think it's going to be a good time.
Yeah, and one of the issues that we had as of this morning is that Treasury yields have jumped up again because prices and yields are inverse in movement. So the demand for Treasury has gone down, so prices have gone down. And so yields have jumped up. The 10-year Treasury bond today was 4.9%. I think it's the highest it's been in 20 years or so. The stock market is doing well, but if these bond yields keep going up, there's going to be a lot of issues with borrowing, and the HUD loans that we always talk about are based off of the 10-year Treasury. So as the yields go up on the 10-year Treasury, the prices go up on those HUD loans, which are backed by the U.S. government, and which normally gave a much better terms than the average private lenders. And those private lenders are about 8.5%. I mean, what were you hearing from the people we talked to in New York?
Yeah, in just in open discussions, everybody's seeing way closer to 10% interest on the commercial lending side, and there's really not any near future relief in sight.
Yeah, and as of this morning, like I said, residential mortgage rates for the 30-year fixed mortgage hit 8%. And so, it'll be interesting to see. We did a podcast on this before that, there's a lot of commercial mortgage-backed securities that are due for renewal in November and December, and what is going to happen with a lot of these multifamily properties that were bought on floating rates, and maybe they were at a 3% floating rate, and now it's going to be a 10% floating rate, and they don't cash flow. What's going to happen?
Yeah, that was a really hot topic, and there was a lot of people that are currently in that situation, and they're trying to restructure their deals, and they're going back to their lenders. They're looking for other avenues to get a new influx of cash into their projects. There's cash calls going on. Distributions are being halted on some of these projects, and it's a real problem.
Yeah, and one of the things that one of the debt panelists talked about was rate caps. And he said that, 2 years ago, a rate cap would be, $20,000 or $30,000 for a $20 million loan, and now it's like $300,000. So even those rate caps, in case our audience didn't know, a rate cap is basically an insurance policy that you purchase for a floating rate. That if the floating rate goes above a certain number, certain percentage, the insurance company will pay that difference. So the borrower is protected, but it is an insurance policy, and insurance policy has a premium, and those premiums have gone up. They're unsustainable at this point.
Yeah, these are really challenging times for investors right now, and I think paying attention to your syndicator or sponsor and how they're handling this, and how proactive they are in this, and communicating with their lenders and also their investors, to make sure everybody knows where they're at. These are really trying times, and for all the people that did the floating rates and they're struggling right now, what do you do today as an investor? What would you do, Jay? What would you be looking for today going forward?
I mean, exactly that, right? I want to be the sponsor, or if I'm investing as a passive investor, I want to find a sponsor who is constantly communicating with us and who is letting us know what's going on, what the issues are, how they're going to deal with those issues. And we want proactive sponsors, just like you said. Now, one of the interesting examples that one of the panelists gave was that our insurance rates, their insurance rates in a multifamily on the Gulf Coast. So you're talking about Texas, Louisiana, Florida, any of the Gulf Coast states. Well, we've been having this issue for the last couple of years where commercial insurers are pulling out, and you only have one or two insurers left, and so rates are going up. And he basically said, look, our insurance went from, $400, $500, $800 a door to $2,000 a door. And he said, we went ahead and we communicated with our investors, and we let them know, look, there's not going to be a cash distribution this quarter, because we need to have that cash in order to be able to pay for a larger insurance expense. But at the same time, we as the sponsor are not going to charge an asset management fee either. So we won't make money and you won't get your distribution, but we'll all try to keep cash preserved for the long-term investment.
Yeah, I really like the fact that, when your sponsor's proactive and ahead of the curve, it really kind of makes you feel at ease as an investor, even if it means you miss a distribution or two, so that they can build up a little nest egg for the premium, because a lot of people are renegotiating higher premiums, different things to offset, some of the cost. One of the good things that's happening out of this as an investor, the deals that are getting money, the deals that are finding lenders are really good, solid deals. And as these things turn the corner, to be in on these projects is going to be key.
Yeah, because this is the normal course of a cycle. In the beginning of a cycle, you start getting the good deals, and then everybody starts jumping in, and then FOMO, fear of missing out. People are like, "Oh, this person got a 15% return. I want a 15% return," and then they can't get into the same quality deal. So in the beginning of a cycle, you get good returns and quality deals. As the cycle starts peaking, everybody starts jumping in, and you get deals that are not of high quality. And those are the deals that start falling out, and people start losing their money. You start declining on the cycle. You hit the bottom, which, probably I would think by the end of this year, we'll probably hit bottom, and then the cycle will probably restart.
Well, isn't that very similar to what happened in 2008 with the residential mortgages?
Yeah, it's almost exactly the same thing. In the beginning, what happened was that investors were getting these bonds. They were buying these bonds that were backed by mortgages and backed by cash flow of the mortgage, and everybody thought, "Wow, this is awesome," because we have a hard asset with people who are living in these houses, so they're their own residences. So it's not we're not talking about some kind of a risky business, right? We're talking about somebody's home, and these new products that are coming out on the market. These are bonds that are backed by A-class people with 700 plus FICO scores. These are the people who bought these houses, and they're going to be making these mortgage payments, and these bonds are backed by those mortgage payments. Well, in the beginning, they were very, very high quality bonds backed by people who had 700 plus FICOs. Well, there's only so many of those. Then you went to the 600 FICOs. Then you went to 650, then 600, then 550, then 500. Then the appetite, FOMO, the appetite for I want to get into a mortgage-backed security was so great that Wall Street started packaging them as ninja loans, right? If you don't have a job, you don't have, so ninja was no income, no job, no asset verification. We're just going to give you this house, and we're going to give you 100% financing because we just want the asset to package into a bond and sell it to our investors because there was so much demand for it. And, the result was 2008, everything collapsed.
Well, with all that being said and all the doom and gloom, I hope we didn't deter you from doing your homework and your due diligence and really staying involved and getting invested. I really enjoying this Avo, Jay. It's got a nice, like a mild smoke. It's a medium bold flavor for me, or maybe medium, but it has a good full flavor. Just a little bit of spice and pretty consistent throughout so far.
No, this is smoking really well, and compared to the summer and the spring, I thought the spring was a little bit more floral. This is a lot more woody, much more fall based, as they said, because this is for the fall season. A little bit more woody, more chocolate. I'm getting more chocolate out of it. Not too much spice, but just enough to make it interesting. But this is a wonderful smoke, and if you can get your hands on this Avo seasoned cigar, this is the fall version. They had the summer and the spring before that.
Well, I hope y'all enjoyed the episode today. Looking forward to seeing y'all next time. Any questions or comments, please hit us up. In the meantime, go to our website, check out our articles, and look forward to seeing y'all next time.
Have a good afternoon.
Yeah,